July to September is at 1.2% of the GDP. Latha Ventakesh is here with the analysis. Latha, what did you make of these numbers?
Well, actually, they're a bit of a surprise. At 1.2% of the GDP, the current account deficit for the April-June quarter, the July-September quarter that we are studying is half of what it was in the previous quarter. Previous quarter, that is the April-June quarter, it was 2.5%. What has worked for us is that there have been more services exports. So software services, whereas they gave about $17 billion last time, 17.3 billion. This quarter, they have given us almost $18 billion. The other thing that has worked for us is private transfers. Indians living abroad and sending money home to their families. That was about 14.6 billion in the previous quarter. That is the first quarter. This time it has risen to almost 15.8 billion. So there has been a substantial jump in the cases of Indians living abroad and sending money. But the best number is not in the current account, but in the capital account. And that is the FDI number. Whereas FDI was $7 billion in the first quarter, that is the April-June quarter. In the second quarter, it has come in at 12.5 billion, almost 12.4 billion. So in terms of balance of payments also, we have done pretty well. This is, I would say, actually a pleasant surprise in terms of the current account deficit, better than the expectations of some of the people I spoke with. But let's get an expert in. DK Joshi, Chief Economist, Crisil, joins us on the phone line. Mr. Joshi, 7.2 billion current account deficit, better than you thought, worse than you thought?
Well, I think our forecast for the full year was 1.5%. So we were expecting a correction from 2.4 in the first quarter in any case. And I think the good news, as you said, pointed out, is that the FDI flows are so buoyant that they actually cover up the entire current account deficit. So they're more than financing, so which is very positive. I mean, so the CAD is not being financed by short-term flows, but by more durable FDI. So that's another piece of good news here. And I think for the year as a whole, as I said, we expect it to stabilize at around 1.5% of GDP, which is higher than last year, but substantially below within the safe limit, which is considered about 2.5% of GDP.
Okay, so at the end of the first half, the current account deficit is at 1.8% of GDP. You expect that in the second half, we are going to get closer to 1%, so that your average of 1.5 is met?
True.
Okay, all right. Well, we'll leave it at that. Mr. Joshi, thank you very much for joining us. So that's a pat on the back coming from Mr. Joshi as well, that the current account deficit is much lower than the first quarter and in line with what he expected. But I think the best part that he's pointing out is that FDI is at 12 billion. And FDI normally comes in for the long haul. You know, you put in a factory which should last for about 30 years. It's not money that you will pull out. It's not an investment in shares. And that FDI that came in the second quarter was double the current account deficit. So, no problem with the deficit.
No problem with the deficit. Thank you so much for those details, Latha.